Hey, welcome to the show, Total Financial Solutions, Safer Money Hour. Arif, Halaby along with Jeff Gerard, talking about your family's finances, of course, getting out of debt, managing money, planning for your retirement and your future. What is that all about? Well, your future should include, hopefully, retirement. Now we say, well, what does that all mean? Why do people talk about retirement as if it's this, magical thing that happens? Because for a lot of folks, retirement is some of the worst things you can ever do. And they might say, well, wait a second, I thought that's what you guys are all about. Well, it is in a way, because retirement is stopping working for money that you have to earn. Now, here's the difference. In the normal retirement world, think about it like this. Part of your plan is to build your wealth, to save money, and to create maybe a legacy for some of you. Maybe that matters. Maybe it's about passing on your knowledge to the next generation. I know that we have a lot of business owners, former business owners that are retirees, that actually do that here at Santa Clarita. The different business centers. I know they do that also in the Antelope Valley. But did you know that this amazing thing called ObamaCare, or I guess affordable health care, which really isn't affordable, so we're not going to call it that. We'll call it what it really is, which is ObamaCare.
Right.
Did you know that if you are getting a subsidy, you're actually receiving money? Do you know they put a lien on your Medicare? They put a Medicare lien on you? You're like, what?
Wow.
They put a Medicare lien on you. The money that you thought you were getting for free, they actually put a lien on your estate. So if you happen to come into money later in life, whether you inherit it because your 96-year-old grandmother passes away or your 97-year-old mother passes away and you now inherit money, the IRS can take that because for a decade or more, under Obamacare, you received a subsidy. Now, I'm sharing that with you as if, and it is, a shock, because it's a shock to me. Remember that whole thing that Nancy Pelosi said, which is, first we have to pass the bill to see what's in it. Okay. Well, that's what they did. And guess what's in it? Attaching your wages and your income, including Social Security. Did you know that your Social Security is not just this magical thing that you deserve to be paid? Ever since they took student loans and put that into the hands of the IRS as far as collection goes, and ever since the federal government put the Obamacare subsidy, the bill collection agency for the Obamacare subsidy, to be the IRS, is it any wonder that those subsidies are now a lien on your property, a lien on your assets? So you really have to think twice about, one, getting the subsidy, but two, how to plan your life so that you're not stuck down that road.
Well, we all know there's no such thing as a free lunch, but my goodness, to not see this coming. I mean, if it's not in the form of taxes, it's in the form of these hidden things that are coming down the pipe. And I think so many people, look, we can't opt out of this. We can't say in most cases that, oh, no thanks, we don't want that. I mean, we were all kind of painted into this corner of everyone being required to have health coverage in some form or fashion, and where you qualify is in how well you do. So if you don't do very well, they're going to get it to you free anyway. And if you do well or well enough, or you're just getting by, you got to go out and buy it. And if you don't, oh my goodness, it just seems like every which way we turn, we're getting, hit left and right. But I'll tell you, this is an eye-opening experience, because what we're seeing is some of the proof that they're not telling us everything. Well,
here, take a look. 4 out of 10 low-income Obamacare participants will actually face sticker shock this April 15th. This is according to the Daily Caller. Here's what I mean by that. A family of 4 could owe as much as $11,000 in penalties and fees. 11 grand. In fact, we have one particular client that owes, for her and her family, $6,000. And they said, we don't understand. We thought we did everything that they said. We filled out the forms correctly, we thought. And sure enough, $6,000. As if people just have an extra $6,000 to send to the IRS.
And they had health insurance, did they not?
They had health insurance.
So they went out and bought coverage, which is not cheap. And then in addition to that, they had to come out of pocket $6 grand.
And what you do is you look at that and you say, well, there's got to be, somebody to explain this stuff. There's nobody that understands this. There's people that understand pieces, and some pieces maybe pretty well. But the problem comes into play when you're trying to figure out what in the heck is happening to your financial life. right? That's a big deal.
Well, it is, and because we're doing what we think we're supposed to be doing, okay, the rules change, we adjust our financial lives accordingly, and we're starting to see that it's still not satiating some of the rules because there are so many little things that, like we said, they're just not known, they're not up front. So you have to be careful, and like you said, where's the silver lining? Do you find a professional? Do you find someone that's an expert in this? The truth is, I don't think there are any.
Okay, here it is. Low-income Obamacare earners actually are subject to what's called a clawback rule, where they can go back into your assets, and this is a running total. This is a lien that sits on this ongoing basis in your assets. Meaning, and this is important, since 2010, the Affordable Care Act advocates have actually known about this. So it's not as if it was a secret. It's been around for 5 or 6 years now. Repayment requirements could lead to public dissatisfaction with the exchanges. So what does that mean? If after a little while you're going, you know what, enough. We're not going to give to the exchange. We're going to go direct. What will happen to the big bucket of dollars? Because if people can't afford it, they will go to the place that's the least expensive. If people can, and they're being penalized for going to one place, they will go to a different place. And when that occurs, what happens to the extra money that was there to pay for the poor people? It's just not there. I mean, right? Somebody has to pay. Doctors aren't working for free. Nurses, property tax that hospitals and urgent cares have to pay, so the counties aren't going to work for free. They need their property tax money. The electric company, they're supplying electricity to these hospitals and doctors' offices. They want to be paid. I mean, do you understand? It's not those rich, greedy doctors people think. Mm-hmm. It's far from it. In fact, it's almost the opposite. It's become a middle-income job with very, very high expectations of payback. So here's what we are looking at. Taxpayers should also be concerned that the estimates alone on these payments, remember they said it would be $19 billion or something. What is the real number? In 2014, it was over $4.7 billion. Because the repayments are capped, the federal government will only be able to recover a small portion. So why does that matter to you and I? Because some of these dollars consistently will be added to your mom or your dad's estate. And if they had a primary residence, a house, let's say they've paid off their house. It's a $300,000 house. It's been paid off. And they're living there, and your dad passes away, and your mom is living there in that $300,000, $400,000 house, and they're getting all the Obamacare subsidies, and that's the only thing that she in her whole life is going to believe that she can leave to her children or grandchildren is that house. Guess what happens? All of those years of that clawback, they actually go put a lien on the property, a Medicaid lien on the property, and they will take their money. It is not a small problem. This is a big problem.
And the big shock is that it's not coming out in small bits over the course of that person's life. It's going to be something that they may not even have known existed. And then you're going to see this accounting that was done by them, and they're going to say, oh, now it's time to come in and take our cut. And you'll be left with less is what it really boils down to.
And ultimately, your mom or dad's estate could owe money to the federal government. So you have to look at this and say, is it even worth it? Should we instead take, because look, you understand they're not going to just give you the money and just say, hey, you owe us $1,000 15 years from now. If your mom passes away in 15 years, that $1,000 isn't worth the same $1,000. That's why they charge interest and fees and taxes or penalties or whatever they may charge. They're going to call it something, and that's why they're going to be adding those dollars to it. And what will end up happening? If you have gotten health insurance subsidies in the last year and you're worried that maybe you received too much in federal tax credits, which is what happened to this particular client because they didn't know any better. It's a formula. You fill out the forms and it tells you what you're supposed to pay. The IRS will tax you, will charge you back that money. And if you don't have within a 2-week period of time or whatever they give you to pay the money back, now they start assessing you penalties and fees and interest charges. And it's not a little amount of money. And you go, wait a second, I thought I was playing the game that you guys told me to play. No, it's a different game. So it's not really your obligation to pay that's the problem. It's their obligation to communicate how much you're supposed to pay. We know that we're supposed to pay what we owe. That's not a problem. Apparently, sometimes it is. But Obama's got more nerve than what they say. I'm just reading some of the comments, because they actually sat there in front of a group of people and said this would not happen. And of course, in today's internet technology, you can go to the internet and see the context before and after, so you can make sure nobody's playing funny games with the words. And you can see that the expert, Mr. Goolsbee, I can't remember his first name, Mr. Goolsbee, who was the, quote, economist from Chicago, one of the universities in Chicago, said, oh, this would never happen. And in fact, it did. You could look at the experts across the board, economic experts. This would never happen. It did. But if you looked at the 90% of the experts on the other side of the equation, they all said this is inevitable. 1 + 1 is 2, whether you want me to pay it or you. So if you pay nothing and we still have to pay 2, then I'm paying 2, right? Because your 0 plus my 2 still has to equal 2. It's not a game where you can change the laws of physics. So how do we create this? Look, so remember, if you're planning to do this, here are some of the strategies. If you're expecting a mom or a dad to ultimately need the Obamacare subsidy because their income is low, their assets may be high, they may own a piece of property, they may own a farm, a building, but they're not liquid. So how do you get around that? Number one is I would consider life insurance. And you can have a life insurance policy. I know you're thinking, well, they're not young anymore. I get it. But explore things like a whole life insurance policy. Generally speaking, they're not my most favorite policies out there, but each policy has a job to do. It just depends on what the job is. And in this particular example, it might make sense to be a whole life insurance. Maybe you can get a short-term policy, like a 10-year term. Something where the $25,000, $50,000, $100,000, whatever you think you might owe, or a portion of what you might owe your mom or dad or grandparent, where that can be used to pay off their debt, which is what it is. It's just a loan from the government. The Obamacare subsidy is a loan for the poor folks who can't afford it. And in exchange, you can end up keeping the house free and clear. So one of the solutions is a life insurance policy.
Well, I like that, and I want to chime in for a minute, because most people will say, oh, no problem, Arif. I'll just go out and pull money from the 401k or the IRA money that I'm going to inherit from my folks. But what's the drawback to that? That money has not been taxed yet in most cases. So if you pull that money out, who do you think is going to have to foot the bill when they inherit that money and now spend it outside of that plan? You guessed it if you said you. So life insurance is different in that it passes tax-free under current law. So that is one of the most wonderful strategies from a tax advantage standpoint, because you do a couple things. And I like where you're going with the whole life scenario, because it is what's called a cash value policy. So there are other benefits that go just beyond that death benefit. But if we're talking about some small dollar amounts, $25,000, $50,000, that could be a pretty healthy tax-free amount of dollars to come in to pay off that lien on the estate.
Yeah, and I think one of the other options that I want you to look at is to go directly to ObamaCareFacts.com, and that will give you some of get away from the partisan, we don't like it just because it's his idea conversation.
Yeah.
And it will start giving you how you calculate the payment, the premium, and it really gives you some of the truths away from the opinion, I think is a good way of putting it. So what cost assistance must be paid back? You could end up owing what's called advanced premium tax credit, back up to the limit of your income. If you want to avoid this, make sure you double check your income, assets, your calculations, all that formula. Now, remember this. The other solution to this, if you are a parent, if you are a kid, if you will, expecting to inherit that house or the business or some assets, you might be able to get with your siblings and pay for your parents' insurance themselves. Meaning go direct. Get away from the $2 or $3 or $4 or $500 a month subsidy and buy direct. If each of you put in $100 a month and there's 4 of you, that's $400 a month. And if mom was going to put in $200 anyway, now that $600 a month may buy a better policy and then keep her from having to qualify for the Obamacare plan and go direct, and in fact keep that lien from being tacked on to the property for years and decades to come. Yes, I understand you guys are going to have to pay for it. That is not the most cost-benefit way. I get it. But you just probably are going to save yourself a bunch of headache later. So, okay, we'll be back in just a minute. We want to continue with Total Financial Solutions Save Money Hour. What about your 401k? There are some ways to make some adjustments to that, certainly, but you can always go to hometownstation.com, click on Total Financial Solutions, send us an email, send us a question. We'll be happy to cover it on the air. A lot of what we cover comes directly from you, so don't be shy. Feel free to shoot out a question or two. We're happy to cover that when we come back. Arif, Halaby, and Jeff Gerard on your place for news, talk, and information. This is Total Financial Solutions Safer Money Hour.